American corporations are drowning in more than $50 trillion of debt. This is not a distant threat waiting on the horizon, but a structural crisis already embedded in the balance sheets of the companies that employ millions and power our economy. The number itself defies imagination. $50 trillion represents more than twice the annual economic output of the entire United States. It exceeds the combined gross domestic product of every nation in Europe. But the true danger lies not in the size of this debt mountain. The real threat emerges from a toxic combination of circumstances that mirrors the patterns preceding every major financial collapse in modern history. We stand at a moment where interest rates have risen faster than at any time in 4 decades, where thousands of companies can no longer cover their debt payments from operating profits, and where a refinancing wall of unprecedented scale looms directly ahead. This is the story of how America's corporate sector constructed a debt trap so sophisticated that even the smartest minds on Wall Street failed to see it closing. This is the anatomy of a crisis hiding in plain sight. The architecture of every debt crisis follows a predictable blueprint. First comes a period of cheap money that convinces borrowers and lenders alike that the good times will never end. Then arrives the second phase, where debt accumulates faster than the income needed to service it, creating what economists call zombie companies that survive only by borrowing more to pay existing obligations. The third stage begins when interest rates rise or when lenders suddenly demand their money back. Companies discover they cannot refinance their debts at affordable rates. Defaults cascade through the system, taking down not just the weakest borrowers, but also the financial institutions that lent to them and the investors who bought their bonds. History has shown this pattern repeating with mechanical precision. The Latin American debt crisis of the 1980s, the Asian financial crisis of 1997, and the subprime mortgage collapse of 2008 all followed this exact sequence. Each time, experts assured the public that this time was different, that new financial innovations had eliminated the old risks, that sophisticated models had tamed the ancient demons of boom and bust. Each time, they were catastrophically wrong. The only variable that changes is the specific mechanism through which debt accumulates and the particular trigger that starts the collapse. Today's mechanism involves corporate bonds, leveraged loans, and collateralized loan obligations, but the underlying mathematics remains unchanged. When debt grows faster than income for long enough, when interest rates rise while profits stagnate, when mountains of obligations come due simultaneously, the system breaks. We are not debating whether this will happen. We are debating only when and how severely. To understand where we are headed, we must first examine the last time American corporations constructed a debt trap of this magnitude. The 1980s witnessed a financial revolution that permanently altered corporate America's relationship with debt. At the center of this revolution stood a single firm called Drexel Burnham Lambert and a financier named Michael Milken. Milken pioneered the market for high-yield bonds, derisively known as junk bonds, which allowed companies with poor credit ratings to borrow billions. By 1987, the junk bond market had exploded to $200 billion. These bonds financed a wave of leveraged buyouts where private equity firms purchased corporations using borrowed money, loading the target companies with debt and extracting cash through asset sales and cost-cutting. The most infamous transaction came in 1989 when Kohlberg Kravis Roberts acquired RJR Nabisco for $25 billion. The deal used 87% debt financing, transforming a company with $5 billion in obligations into one carrying more than $25 billion in debt. RJR Nabisco's annual interest payments alone consumed most of its operating profits, leaving almost nothing for investment, innovation, or weathering any economic downturn. The entire system depended on one critical assumption. Interest rates would remain low, allowing companies to refinance their junk bonds when they matured, and economic growth would continue uninterrupted, generating the cash flow needed to service these massive debts. Both assumptions proved false. In 1989, the junk bond market collapsed. Several high-profile corporate bankruptcies revealed that many borrowers could never repay their debts. Drexel Burnham Lambert itself filed for bankruptcy in February 1990, destroyed by its exposure to the very instruments it had created. The firm's collapse triggered a cascade of defaults that wiped out billions in investor wealth and pushed the American economy into recession. The lessons seemed clear. Excessive leverage destroys companies, financial engineering cannot replace genuine business fundamentals, and markets that appear invincible can vanish overnight. For a brief period, these lessons influenced corporate behavior and regulatory policy. But memory on Wall Street extends only as far as the last bonus cycle. Within a decade, the financial industry had rebuilt the same structures under new names. The disaster waiting to unfold today emerged directly from our collective amnesia about what happened 35 years ago. The corporate debt landscape in America today makes the 1980s excess look restrained by comparison. According to the Federal Reserve's financial accounts, released in March 2025, outstanding non-financial corporate debt reached $13.7 trillion. When you add financial sector debt, commercial real estate loans, and the shadow banking system of leveraged loans and private credit, the total exceeds $50 trillion. Corporate bonds account for roughly $7.7 trillion of this total. But these numbers dramatically understate the crisis because they exclude the explosive growth of leveraged loans, which now exceed $1.5 trillion. These loans, made to companies already carrying substantial debt, typically feature variable interest rates that reset as market rates change, meaning borrowers face immediate increases in their debt service costs when central banks raise rates. The Federal Reserve began its most aggressive rate hiking campaign in 4 decades during March 2022. The benchmark interest rate climbed from near zero to 5.3% by October 2023, the fastest increase since the early 1980s. For companies that borrowed heavily when rates were near zero, this represented a catastrophic shift in their cost structure. Consider the concept of zombie companies, firms that generate insufficient operating profits to cover even their interest payments. Research by consulting firm Kearney in July 2024 identified 2,370 zombie companies worldwide, with American firms representing a substantial portion. These corporations survive only by borrowing additional money to pay the interest on their existing debt, a textbook definition of a Ponzi scheme that eventually collapses when lenders refuse to provide more funding. The composition of the corporate bond market reveals another dangerous vulnerability. Roughly 52% of investment-grade corporate bonds carry BBB ratings, the lowest tier before bonds fall into junk status. Historical data from Moody's shows that approximately 4.76% of BBB-rated bonds get downgraded to junk each year during normal times, but this percentage spikes dramatically during economic stress. During the pandemic crisis of March 2020, more than $92 billion of corporate bonds fell from investment grade to junk status in a single month. These so-called fallen angels triggered forced selling by institutional investors whose mandates prohibit holding junk-rated securities, creating a liquidity crisis that required Federal Reserve intervention to prevent a complete market meltdown. The refinancing wall represents perhaps the most immediate threat. According to analysis by S&P Global, nearly $3 trillion in corporate debt will mature between 2025 and 2026. Companies that issued bonds when interest rates hovered near zero must now refinance at rates 3 to 5 percentage points higher, meaning their annual debt service costs will increase by billions, even if they borrow the same amounts. Many companies will discover they simply cannot afford to refinance. Their operating profits have not grown enough to absorb higher interest costs, and lenders have grown cautious about extending credit to highly leveraged borrowers. The mathematical certainty of rising defaults is already showing in the data, with Fitch Ratings forecasting the leveraged loan default rate will reach 4.5 to 5% by the end of 2026, and the high-yield bond default rate climbing to 2.5 to 3%. The leveraged loan market deserves special attention because it has grown explosively while attracting almost no public scrutiny. These loans get packaged into securities called collateralized loan obligations, or CLOs, which are then sold to investors hungry for yield. The structure eerily resembles the collateralized debt obligations backed by subprime mortgages that triggered the 2008 financial crisis, complete with the same faulty assumptions about diversification and the same rating agency conflicts of interest. Private equity firms, operating with minimal regulatory oversight, have led the leveraged buyout boom of the past decade. These firms purchased companies using massive debt loads, extracted cash through dividend recapitalizations, and left the target companies struggling under obligations they could never realistically repay. The business model depends entirely on being able to flip these debt-laden companies to another buyer or to public markets before the debts come due. A game of musical chairs where the music is about to stop. The Federal Reserve's own data shows that non-financial corporate debt as a percentage of GDP reached 73.77% in 2025. While this ratio has declined slightly from pandemic peaks, it remains far above the historical average of approximately 60%. More concerning, this debt now costs significantly more to service due to higher interest rates, meaning companies face a double squeeze of high debt levels and high debt costs simultaneously. The mathematics of this crisis permit only a limited range of outcomes. Companies facing unsustainable debt loads have 3 basic options. They can generate dramatically higher profits to service their debts, they can convince lenders to extend refinancing at manageable rates, or they can default. The profit growth scenario appears increasingly unlikely. The American economy, while avoiding recession so far, shows persistent weakness in key sectors. Corporate profit margins have compressed as input costs remain elevated, and consumers grow more cautious about spending. Companies cannot simply engineer their way out of debt through operational improvements when the fundamental problem involves obligations that exceed their capacity to pay under any realistic scenario. The refinancing scenario depends on lenders' willingness to continue extending credit to highly leveraged borrowers, but credit markets have already begun tightening. High-yield bond spreads, which measure the extra interest risky borrowers must pay compared to safe government bonds, have widened as investors demand compensation for increased default risk. Banks, facing their own regulatory pressures and capital constraints, have reduced lending to corporate borrowers with weak balance sheets. This leaves default as the most probable outcome for a significant number of companies. The cascade will likely begin with the obvious zombies, firms that have been burning cash for years and surviving only through continued access to cheap credit. Their bankruptcies will surprise no one and may even appear as healthy market clearing at first. The real danger emerges in the second wave. As defaults mount, investors in corporate bonds and leveraged loans will suffer losses that force them to reduce their positions across the board. This indiscriminate selling will hammer the bonds of even relatively healthy companies, raising their borrowing costs and potentially pushing marginal firms into distress. The contagion spreads through interconnected financial markets faster than regulators can respond. Banks and other financial institutions that hold large portfolios of corporate debt will face mounting losses. The Federal Reserve stress tests may have ensured that major banks can survive a severe recession. But these tests likely underestimated the scale of corporate defaults that could occur given current leverage levels. Smaller regional banks and non-bank lenders face particular vulnerability because they lack the capital cushions of the largest institutions. The collateralized loan obligation market represents a specific systemic risk point. Approximately $1 trillion in CLOs exist, held by pension funds, insurance companies, mutual funds, and foreign investors. If default rates on the underlying leveraged loans spike significantly higher than the models predict, the value of CLO securities will plummet. Unlike the 2008 crisis, where most toxic mortgage securities were concentrated in a few large institutions, CLOs are distributed widely across the financial system, making containment more difficult. The economic impact will extend far beyond Wall Street. Corporate defaults lead to mass layoffs as bankrupt companies liquidate or restructure. Suppliers to these companies face their own crises as major customers disappear. Commercial real estate markets will suffer as defaulting companies abandon office space and retail locations. Municipal governments will see tax revenues plummet as business activity contracts, forcing cuts to public services exactly when citizens need them most. The Federal Reserve faces a cruel dilemma. Cutting interest rates might provide some relief to debt-burdened companies, but it risks reigniting inflation that took years to bring under control. The central bank may also lack the tools to prevent a corporate debt crisis because the problem involves not cyclical economic weakness, but structural insolvency built up over more than a decade of misallocated capital. The most historically literate observers recognize that we are living through the late stages of a debt supercycle that began after the 2008 financial crisis. Central banks responded to that crisis by cutting rates to zero and creating trillions in new money through quantitative easing. These policies succeeded in preventing a depression, but created new imbalances as corporations gorged on cheap debt. Now, as central banks attempt to normalize policy, the accumulated fragilities are being exposed. Timeline predictions are inherently uncertain, but the refinancing wall of 2025 and 2026 creates a clear catalyst. Companies that cannot refinance maturing debt at affordable rates will have no choice but to default, and the cascade of defaults will then propagate through markets according to the interconnections between borrowers, lenders, and investors. The conventional wisdom holds that American corporations are fundamentally sound, that rising debt levels simply reflect rational borrowing to fund growth, and that any problems will prove manageable through normal market mechanisms and modest Federal Reserve support. This conventional wisdom is dangerously wrong. The contrarian insight that emerges from examining the patterns of debt crises across history is that the most dangerous moments arrive precisely when everyone believes the system is safe. The financial engineering that appears sophisticated during good times reveals itself as nothing more than leverage and speculation once conditions change. The innovations that supposedly eliminated old risks simply concentrated those risks in less visible places, where they grew larger and more destructive. We are not watching a potential crisis develop. We are watching the late stages of a crisis that has already occurred but has not yet been recognized. The debt has already been borrowed, the bad investments have already been made, the companies that cannot survive have already been loaded with obligations they will never repay. The only remaining questions involve timing and the specific sequence of failures. History provides an uncomfortable lesson. No major debt crisis has ever been diffused through gentle managed decline. The mathematics of unsustainable debt permits only two outcomes. Either the debts are repaid, which requires economic growth and profits that the data suggests will not materialize, or the debts default, triggering exactly the cascade of failures and contagion that optimists insist cannot happen. The truly contrarian position today is not to predict disaster, as disaster is already baked into the numbers for anyone willing to examine them honestly. The contrarian position is to recognize that this crisis, like all crises, will eventually pass and will create opportunities for those who understand what is happening. The debt trap that ensnares American corporations today did not arise from malice or stupidity. It emerged from a system of incentives that rewarded short-term thinking, from monetary policies that kept interest rates artificially low for too long, and from human nature's eternal tendency toward optimism and greed. Understanding these dynamics does not prevent the crisis, but it illuminates why we find ourselves here and why we will almost certainly find ourselves here again in the future, unless the fundamental incentives change. The $50 trillion debt trap is closing. What happens next will reshape American business for a generation. Those who study history will recognize the patterns. Those who ignore history will repeat its most painful lessons.